So what I thought was we've done a lot of bit of lending here and there. We talked about how to approach your first kind of meeting. Like we talked about pass your card if you happen to have an opportunity to pitch. We talked about last week what to pitch, what to tell them to get them to come here, right? If you guys have any question, we can review. We're gonna have a shorter class again, no lunch until 12:30, so you guys can go. But what I wanted to cover, continue with lending until we do the probate. What I wanted to talk to you guys about is, again, lending, continuing with lending. The two most popular loan types that that everyone uses most often in the full doc category, and those are the FHA and the conventional. I know one of our agents had a hard time finding an FHA approved building in city of Glendale. However, a lot of cities do have a lot of buildings, so FHA is a very popular program because of everything we're going to review. So what I did was I printed some of the bullet points that would help you guys. I think 80% of it you guys may know, but it would help you guys in a conversation. What is a conventional? What is an FHA? And what's the difference? So any of you guys that have a brother, relatives, family, they want to get a loan, chances are they'll fall into one of these two categories. Now, if they're self-employed, right? Like I'm self-employed. You guys as an agent may be self-employed because you get paid 1099, right? If you are self-employed, then chances are you will have to file your taxes. Based on your taxes, you can go with one of these programs, or you will go with what we talked about last time, like a bank statement loan, profit and loss. There's more programs that are non-full doc, like non-QM, okay? So conventional and FHA are the more popular types. I thought about, we'll just kind of, let's start with the FHA, okay? And we'll just kind of read it and answer questions if you guys don't mind. So Joel, if you don't mind, please, the picture that the family says summary, if you could read the first two paragraphs for us.
Sure. Real estate professionals should familiarize themselves with the many mortgage products on the market, including FHA loans and reverse mortgages. FHA loans have grown in popularity recently. One FHA product is the home equity conversion mortgage, which is a reverse mortgage. Reverse mortgages are designed for people over 62 who may be house rich but cash poor. It is a loan that uses the home's equity as collateral. More information on FHA lenders can be found at www.hud.gov.
So I think this is the website that one of our agents went and got some information for buildings that are approved. You can find a lot of programs. I'm not going to get in today to answering any questions about reverse mortgage except what you read. If you guys are interested, feel free to come up to me after our meeting today. I can guide you to some places we have also books that you could study on it. But that's what you need to know. I want to put our focus more on a loan type that we use, which is just the regular FHA, okay? So having said that, now let's jump into the actual, the FHA full doc. Continue reading, Joel, the next paragraph, please.
FHA loans are popular because of their low down payment requirements, currently 3.5%, and the ability to negotiate up to 6% in seller concessions. Buyers need to understand certain concepts, however, when investigating the FHA loan.
Okay, so basically, guys, everybody knows the 3.5%. What is a seller concession? Okay, so if you are negotiating with the other party and you represent the buyer, you can get some credit, okay, towards buying down the rate. 6% concession would be 6% of, let's say, the purchase price, okay? So that would help on buying down the rate. Now, some of the key factors in a mortgage insurance that you should know. So if you have, again, you guys, a lot of the younger people like FHA because you put 3.5%. Anybody here can tell us what is the minimum down payment for a conventional loan?
5%.
Percentage-wise, 5. That is correct. Okay, so let's continue reading the bullet points. If Ani, if you like to read those, the first one, please.
They require mortgage insurance premium, but both at time of closing, upfront, and throughout the loan period, annual, paid monthly.
Okay, let's pause there and let me just kind of explain that. So whenever you get an FHA loan, unfortunately, there is an upfront amount that's added to your closing costs. So let me explain that. Let's say you're buying a house for $1 million, okay? And let's say it's an FHA. The closing costs, which is escrow, title, tax, prepaid items, let's say they all add up to $10,000. Okay, let's just say, okay? Then you're gonna see a number that's gonna say private PMI upfront fee. Okay, so that upfront fee is what they're talking about. So usually it's, I don't know the exact amount, Perry can maybe tell us, but it's usually like 5, 10,000, 12,000. It's a percentage of it, and we'll ask Perry just to get the exact number. But whenever you do an FHA, expect that's going to be on there. Now, sometimes, again, we can ask case by case. You can put that in the loan. Sometimes we've done it, but most of the time it's upfront. And then the other one that it says throughout the loan period. So then take the remaining, let's say it's 10,000 a year. They divide it monthly, and then you pay that monthly. That's your regular mortgage insurance. So second one, Ani, do you want to read the second one?
Sure. Qualification will be determined in part based on income to debt ratios. These are calculated at front end and back end ratios.
So basically, the same thing we talked about the DTI, which FHA allows you to have more debt, okay, and lower credit score. And the next one, Caroline, do you want to read the next one?
FHA loans are assumable but intended only for owner-occupied properties.
So guys, what that means is I've had a lot of buyers and say, Kevin, we want to buy a property. We have 3.5%. Can we rent it? And unfortunately, you cannot. So the rule is the first year you have to live in it. Okay? So it's owner occupied. But the definition of assumable, somebody can come and assume that, okay, fine, or you could assume another property, or you could assume another loan. So let's say you're buying a house, you take over the guy's loan. But you can't take over the loan and like get financing and rent it out. You have to take over and you have to live in it. That's what that means. Okay? So here we have the upfront and annual kind of written again. Melody, do you want to read the first one on the top upfront?
Sure. While the amount has changed over time, the percentage of the purchase price must be paid at the time of closing.
That's what I said. At the closing, there's going to be a percentage, which Perry will tell us. We can ask her. And you have to pay that upfront. So it's part of like your expense, okay? Mm-hmm. And then annual paid monthly MIP. Anna, do you want to read that?
While the amount has changed over time, this must be paid each month based on an annual calculation of the balance owed.
So again, there is a percentage. There's a way they calculate that. They get a yearly, they divide it by 12, and you have that. You have that every month. So usually, mortgage insurance in general is with all your full doc products as when you have under 20%. Okay. When you move to no full doc, like non-QM, stated income, bank statement, then you don't have mortgage insurance. But you have a lot higher rate. Okay, so that was for our for FHA. Before I go to conventional, guys, any question about FHA? Anything you guys want to discuss? Anything you guys want to share regarding FHA?
The part that says the FHA should be owner-occupied property, at the time that you are buying, it should be owner-occupied. I mean, you have to just, how do you prove that?
So it's very easy. So when you buying a place, the first year you have to live there. That's the rule.
After that, you can have it.
After 1 year, you're able to do as you please. Yeah. So the lender will ask that. I think we can ask Perry again as a processor. They might have you sign the document too, but it's owner occupied, so you will have to live there.
I have a question.
Sure.
How much do FHA loans go up to?
I think right now, last time I asked her was $1,080,000. $1,080,000. Don't quote me exactly. We can ask her for that, and she could, because sometimes those numbers change every like few months. So I think it's $1,080,000 right now. So again, loan amount is one thing. Qualifying for the loan is a whole different, obviously, story. What can I share with you guys about FHA? So from my practical experience, guys, I would say with Ani and Perry, 25% of everything we've done have been like FHA driven. Does it make sense? Most of them were younger buyers, first time buyers, lower amount, obviously. But that's what I would say. What do you think, Ani? 30%. So it is, again, I was very surprised when one of our agents says like, there's only 2 or 3 buildings in entire Glendale that you could do FHA. I was very surprised. And I told her that, you know, maybe you had too much to drink last night. I told her that we'll double check that for her, but it seems like true. So, but in Pasadena and in the Valley, when I say Valley, it's just the greater Valley. I'm not particularly choosing one city. There's going to be a lot more. In Santa Clarita, there is a lot too. Okay, so let's go to conventional loans, which is the 70-80% of cases you guys might run into. And Joel, let's have you read the top 5 bullet points, please, from the top summary.
Sure. Conventional loans have certain requirements and features. The better a borrower's credit score, the less expensive the loan.
Let's actually pause and talk about them separately. So guys, with conventional loans, your credit score really matters. With FHA loan, it does matter, but they're a little bit more flexible. Generally speaking, the rates across the board for FHA loans are less. Why? Because the mortgage insurance are more. So you're paying something less, you're paying something more, okay? So generally speaking, the credit score has a bigger impact when you do a conventional loan. And when they say less expensive loan, all they're saying is, let's say if my credit score is 680, the loan might cost me, let's say, $200,000 at the end of the day. Let's just say, okay? And let's say Joel's credit score is 720. Same identical loan, and instead of $200,000 total cost, meaning the life of the loan, the interest, this, that, upfront, whatever, let's say she might get it for 150. So, because annually percentage interest adds up throughout the years. So that's what they mean that the loan might cost you less, because the credit score has a big impact. Joel, continue, please.
They can be used for investment property.
Okay, we all know that. Can do that because with conventional loan, you could just right up front, just rent it out, just buy it and go for it.
Investor overlay may increase the loan restrictions.
Okay, those are some, I've never ran into it, but those are some parentheses rules. Again, we have to check with Perry, with Freddie and Fannie Mae, what their policy are for investors overlay. Continue.
Seller concessions for owner-occupied homes can be negotiated up to 6% with at least 10% down and up to 3% with less than 10% down.
So that's just what it is. So less than 10% up to, more than 10% up to. That's the seller concession, is the seller credit that we talked about. Continue.
Seller concessions for non-owner occupied homes can be negotiated up to 2%.
So again, if somebody's buying a house to rent, lease it out, investor, and it's conventional, up to 2% because it's not their primary residence. Continue, Joel, please.
According to the Truth in Lending Act, the lender must disclose the annual percentage rate of the loan when advertising an interest rate. There are certain terms, known as triggering terms, that, when used in advertising, require the inclusion of the actual terms of a credit agreement.
So triggering terms means, you guys might not come across this, but this is just some guideline for advertising for lenders, basically, okay? You might have it in your question, maybe in when you take the exam, you guys take the exam. But triggering means something that is like triggers a red flag and then you get fined, basically. So what they're saying in Truth in Lending Act requires whoever advertised to disclose everything fully, not just put half sentences. But again, this is not something as an agent you will come across. Okay, let's continue. Okay, so Luisa, do you want to read us from select all the way down to the check mark?
Select the items from the list below that correctly describes features and or requirements of a conventional loan. Check on that apply. No seller concession available.
So let's stop there real quick, everyone. So this one, seller concession is available, right? So we don't check it. Continue.
The better a borrower's credit score, the lower the interest rate.
We talked about that. Please continue.
Can be used for investment property.
Straightforward, straight up from the beginning. Yes.
Requires no down payment.
Well, it's not a VA. What is the only loan, guys, that doesn't require any down payment? It's VA. Continue, please.
Not made or insured by a government entity.
So you guys know if you get a conventional loan and you put 10% down, do you guys know, do you still have mortgage insurance or you don't? What do you guys think? Yes? You do? We do. Yes, we do. But it's not MI. It's PMI. It's private mortgage insurance. Okay, the other one is MIP, which is mortgage insurance premium. FHA mortgage insurance is backed by government. Conventional is not. Okay, not made insured by a government entity. That's correct. So go ahead and finish us off, Luisa, with the last one, conventional.
Conventional loans have certain requirements and features, including the better a borrower's credit score, the less expensive the loan. They can be used for investment property. They're not made or insured by a government entity.
So that's pretty much the same thing as up there. So basically, generally, I think with today's discussions, Caroline, Luisa, Ani, you three are pretty active right now, bringing clients in. Ani, there's so many Annas and Anis. You guys notice I have to start like initially. So Ani in the corner, Luisa and Caroline, you guys are active with clients. So it's good to just refresh our mind the most common loan types. Like I said, Luisa helped a little bit with knowledge. She did research. She's very good in research. That, FHA buildings, because she has an FHA buyer. So what she did, she went to the HUD website and she learned how to look things up. And she realized that there isn't that many buildings in Glendale. So she told her borrowers, hey, you may have to put 5%, for example, down instead of 3.5%. Okay, so it's good to know these different programs when you guys are talking, but always remember conventional and FHA loans are full doc programs, meaning you do require that those lists that I taught you guys that I put on the board last week, that all of them had two. If you guys remember, who can name one of the things you need, Ani?
2 months bank statement.
2 months bank statement, just one. Okay, stop. 2 months bank statement. What's the other two that you need? Everything has a two. Last two pay stub. What's the other two that we need?
Tax return?
Last 2 years tax. Say the two. Enjoy saying the two. Last 2 years tax return. Everything is two, right? Last 2 months bank statement, last two pay stub, last 2 years tax return. And what's the tricky two that I made up? The other tricky two? Two forms of, maybe we can say we need 2 forms of ID. We need obviously a driver license, and if they have the social security card is good. That would be also wonderful. So those are like the twos, you know what I mean? So when you do talk to someone that's interested, place of your work, and says, hey, I want to get a loan, I make good money, I have W-2, my tax return, what do I need? Just remember the twos, okay? Last 2 month bank statement, last two pay stub, last 2 year tax return, 2 forms of ID, and obviously the credit report. With that, you could pretty much boom. So how does the credit report, guys, when you're looking at someone if they qualify, how does the credit report play a role versus all those last two? Think a little bit. How do they play a role?
Your debt.
Exactly. So on one side, you have all the debt of them, right? And then with the twos, let's just call them the twos. With the twos, you have all the income, right? Now you're able to put that together and get their DTI. Remember, the rule of thumb with the twos is they have to be either in the same line of work for 2 years or the same company for 2 years, or they have to have a recent degree of a bachelor or higher. So let's just redefine that. So let's say Joelle wants to buy a place. We look at her credit report, her debt, we look at her income, everything is good. Now, Joelle has, let's say, for example, she has worked for Macy's as a manager for like a year, and she also has worked 6 months in TJ Maxx as a manager and 5 years before that in Marshall's, right? That's fine. She's been in the same line of work, right? Even if it was sales manager, she's been in the same line of work, right? Or let's say Joelle has worked 2 years or 5 years at Macy's, then even easier, right? That still qualifies. But what if Joelle has only worked 6 months in Macy's and 8 months ago she got her bachelor's in, I don't know, something with like dental, let's say, for example, or some kind of a certificate, educated certification that we have to double check in a certain field that allows you to get a job right away. So sometimes the 2 year, guys, the 2 year experience in the same line of work will be replaced or can be replaced by a degree. Because what they're saying is if you had a degree and you went to school all these years, you were able to get a job. So as long as you get a job and you have your degree, then you don't need the 2 years. But if you just get a job at Macy's as a manager, right? And before that, she didn't have anything, then that's not enough. Now, this is a question for you guys, and then we could stop. We have 10 more minutes, we'll stop at 12:20. How do you, and you guys can ask your question, how do you distinguish the 2 years line of work? How can we tell? What's the easy way to see if someone has been in the same line of work? If they tell you, oh, I started my Macy's job 3 months ago. How can you tell the 2 year experience without you just trusting what they say? What did you say, Carol? What did you say? Tax return, right, tax return. So if you go to their tax return, when you guys do your tax return, please, starting now, something new, something brand new for you guys to know when you do your tax return. On the first page of your tax return, there is a place that says your occupation, right? So I've noticed some tax accountants, they don't put anything. They just put like blank or self-employed. Have them put your position. So that's one place. Second place, somewhere in the middle of the page where either Schedule C is or another schedule is, they list your occupation. That's the important one, not as important as the first page. So, for example, if you are a student, you're not a student. If you are a student, you put student. If you work at a hair salon place, you can put customer service or you can put sales, right? Because that's how they look at your 2 years. Doesn't matter if you're like, let's say, cashier right now at a nail salon, or you're a cashier at a hair salon, or you're a cashier at Ralph's. It doesn't matter. You could put cashiers or sales. But if it was me, I would put, like, if I'm in a hair salon and I'm customer service, I can put customer service or I can put sales. So for some of you guys, hey, come on in. We're almost finished, but come on in. Don't flip over the wire, please. You are right there next to Joel. There's 2 chairs. So for some of you guys that are younger, that you guys may buy a house like in the next 2 years, 4 years, 5 years, think about the last 2 years. Experience is important. For you, for the ones that are going to school and you're gonna, get degrees, that's all good. So those are some of the little key factors. Yes.
How about the letter from employers? Would that help if you're a W-2?
What do you mean? What do you mean by a letter from employer? What are you relating? What's your question?
You require, you request your employer give you a letter that you've been with them for 2 years or
No, that. So,
or
okay. So if your question is in regards to showing the lender that I've been at a position for 2 years? Can I get a letter from the employment, right? The answer is like, doesn't make sense. The answer, the question doesn't make sense. Let me tell you why. If you have been with a company for 2 years, it will have to be on your tax returns as part of a 1099 or W-2. The letter is not necessary because those are the documents they want. So if the letter, let's say, yeah, you can get a letter and the letter says so-and-so has been with this company for 2 years. They're gonna say, well, thank you for the letter, but we don't need the letter. Let us see your tax return. Let us see your tax return. No, it doesn't. No. When does a letter help from an employment? Let's just say you've been working somewhere, you're about to get a raise 2 months, you're scheduled to get a raise. You can get it, you can ask for a letter, not in all cases, take the letter to the processor, have the processor give it to the lender might accept that letter as your raise now rather than 2 months from now. It depends on the company, so many things it depends. That's when in one case a letter will help. So, and beside a letter, I don't want to say a letter, sometimes like employment contracts. So let's say, Louisa, you just got your master in something and you're going to get hired 6 months from now and you have a contract from that company that you are going to get hired. Or let's say you're in a big position, but you're going to transfer to another company. Then employment contract helps. It's valid. So basically, employment letter and contracts are usually good for transferring job or for upcoming job when you have the degree or when you have the history behind you. But in a lot of cases that we've dealt with, I remember it's been raises. They've had like raises coming up, like, you know, those letters help. So we were talking about the last twos and we're talking about the debt. That's important. We're talking about when you do your taxes, guys that are, again, kind of maybe starting your career and stuff, make sure they put your occupation and make sure you put a good title, a real title. I mean, it's the truth, but you know, there's a difference between maybe cashier than customer service, you know what I mean? Or sales, you know, sales executive, you know, so account executive, you know? So that's important to do. The 2 years history we talked about, this was actually good for you to miss, Meg, because you're a loan officer, so you know most of those. Okay, any other question with comparing the twos? Remember, the twos also go for FHA. If somebody wants an FHA loan on a full doc, the twos apply. The only difference with an FHA, there is going to be three main differences with FHA. Who can tell me those, and then I'll stop and you guys could ask questions. What's the first difference on an FHA that stands out when you're comparing the two files, when you're qualifying someone? What's the first one? FHA versus conventional? Go ahead.
The percentage down payment?
The percentage down payment, they can put less down, that's correct. What's the second one? The one your both of them your client wants to wrestle with. I'm saying your client. Yes, higher DTI. So the FHA allows you to have less income, more debt. Yeah. Less income, more debt. So for example, if Ani has $2,000 debt, let's say, with her new debt, with her new mortgage, she's buying a studio for herself, and her income is $3,900. If we do the calculation, she qualifies for FHA. But if we do the calculation, maybe she won't qualify for conventional. So that's the difference. Less income, because maybe. So we can actually do it. Can someone on their phone take $2,000 for all of you guys? Why don't you, all of you guys? Except Anna doesn't have a phone. Everyone. Anna doesn't have a phone. $2,000. And why don't you guys divide it to 53%? What do you get?
$3,773.
$3,000?
$773.58. I don't know if you want to.
Okay, and then guys, take 2,000 and divide it by 47%, please, as well.
It's 4,255.
Okay, so Guys, so let's finish off on this. It's all a good reminder for you guys. So Ani here, she's buying a studio, okay? She's buying a studio for herself. Her complete mortgage is around $1,700. Her car payment shows up on her credit $300. She has no other debt. So her debt is $2,000, right here, $2,000. Now, she makes only, she told us, how much did you say you make? $3,900. She says she makes $3,900, right? We'll put here, $3,900, okay? She makes $3,900 gross. That's her income. She's been working at JCPenney, manager, 2 years, $3,900. So, you see, actually, I don't know. This is okay. So, with FHA, she needs to make $3,773 to get this loan, right? Well, she makes $3,900. She qualifies. With conventional, she needs to make $4,255. She makes $3,900. She doesn't qualify. That's kind of the, because on this one, I divided the 2,000 by 53%. On this one, I divided by 47%. Okay? So again, there's front end, there's other things, but just as an example. So the second thing is DTI. What's the third and last one?
FICO score.
FICO score. So FHA allows you to have a lower FICO score, a lot lower FICO score than conventional, and they're more flexible if you had a bad history to do explanation. Okay, guys, so that was a quick review of conventional and FHA today. Hope it helped. Any questions? No?
No.
Awesome.
I have
Wait,
one
question. Louisa is not going to let you go, Ani, that quick. Wait one second.
Regarding this seller concession, at what point we request for seller concession or we ask for? Like when you do the RPA at that time,
Mhm.
or like
Mhm.
when you are closed, you are in the escrow and you're almost
Mhm.
closed
No, before.
before? And for whatever reason, it can be credit
It
toward.
can be
repairs.
for, it's basically for rate buy down, okay? Now, at what point I would say it depends on the house. If there is multiple offers and people are going over asking, the seller concession you could ask, but they might not accept. But if this is the only property that there's no other buyers, you're the only one trying to get it, and you know it's priced a little bit not so great, then the seller concession may make sense.
I understand, but like when you are just